Y'all, so I done put all this on a whiteboard for y'all. I'm finna break it down to you, right? So, boom. First thing you need to know is Apple, right? This is the stock. Apple, this is the stock, right? And when you go on your app, whatever app you use, and you look at the stock market, you go to Apple, you're gonna see this. On my whiteboard, Apple is trading at $230, right? So boom. Since Apple is trading at $230, an option gives you the opportunity to either assume that Apple will go above $230 or below. So if you're on the above side, that means you're on the call side. A call basically means that, yes, I believe that Apple will go above $230. So with that being said, if you believe that, then you will go for a $240, $250, or $260 call. This call right here, damn, I just erased it a little bit. This call right here, it costs the most because it's closer to this number. It's closer to the strike. It's closer to the strike price. So with that being said, whatever closer to the strike price is always going to be the most expensive contract, right? That's because it's valuable at the moment. Remember that word is valuable. This right here is very valuable right now. Valuable, right? So when you go further away from the money, you're going out the money. 250, 260 is out the money. They cost a little bit less because they're away from the strike price, right? So if you wanted to go cheaper and also just really believe that Apple is about to take off or do something, then you go 260. But with that, you can also go to this called the expiration dates. You can take that 260 call, and instead of getting it we in the month of November as I'm recording this video. So instead of buying the 260 call that's going to expire in November, because that literally only gives you this month for Apple to go to 260, which is very unrealistic for a stock to jump $30 in 1 month. It happens, but it's not gonna always happen. You feel me? You just gambling. So you could take that 260 call, and you can take it to February 2026. This is gonna cost a lot of money because time costs money. All right. The same way the dollar signs get more as you closer to the strike price, the dollar signs get bigger as you go further down this line of time, which is, time. You go further down type shit. So those are calls. And you can also take a $240 call, and instead of just getting it for November because you feel like it's going to go above 230 or go above 240 in a month, you can take that all the way to February. Because if you were to buy this February contract for the price of 240, that strike price of 240, then you could wait all the way to February 2026 to sell that contract. And by then, Apple surely would be above the price of 240. You see what I'm saying? Okay. Now, we on the put side, right? Everything that I said for calls goes the same for puts. It's just opposite. So if you believe that Apple is going to fall below the price of 230 that is currently trading at, this is the stock market, this blue line. It's the stock market. Right now, the price of Apple is at $230. But if you believe that it's going to drop below $230, then you will go for a put. You will be a put guy. You will be on the put side. You see what I'm saying? So you will go for a 220 strike price, a 210, or a 200. Mind you, on the app, these are going to be real contracts that you can buy. It's going to be prices type shit. So this is going to be the most expensive. Can you tell me why? Why? That bit closer to the strike price. You feel me? It's closer to Apple's trading price that it's currently trading at. So if you're going to buy a 220 put, you're going to pay more money because this can fall to 220 very fast. So this right here is very, very valuable. Once again, this strike price contract is very valuable. These aren't just numbers right here. These right here are contracts, right? These are contracts, all right? These are contracts. That's what you trade in. When you trade contracts. And when you trade, you can't just trade nothing. What you trading? You traded contracts, all right? So that's the word they use is contracts. So 210, this is less valuable, but it's still pretty valuable since it's close to 230 because it's only $20 close, less. And, time comes into play with these contracts also. So you can buy a 210 put, and you can buy for February 2026, which is probably like 4 more months from now, or 5, 3, 4 more months. And You know, it's gonna be expensive because you going all the way down the timeline, but still, it's gonna be smarter because if you really believe that Apple's gonna fall below 230, give yourself time for it to fall below 230. You see what I'm saying? Y'all catching on? Because if you buy a 210 call for November, do you think Apple's gonna fall to 210 in a month? Something drastic has to happen. That something drastic has to happen for this stock to just fall to 210 in a month. You feel me? It happens, but it has to be drastic. You really put your money up. If you're gonna do that, I'll say you gonna short the market. Well, that's what they call it. Give yourself at least 3 months, which is November, December, January. You feel me? Buy a contract that's gonna expire around January, so you're not just playing with your money. You see what I'm saying? So this should make sense to y'all. Honestly, this should make sense for real. This is a good breakdown right here. You see what I'm saying? It's a good breakdown. A call means you're going to go above the price, meaning that you want to buy a contract that's telling you that Apple's going to go above 230. A put is opposite. So if you're going to buy a put, you're going to buy a contract that's lower than the strike price. And if you stay close to the original strike price, it's going to cost more. When you go out of the money, it costs less. When you go further away from the money, remember I said that? It's called out of the money. These contracts that's 240, those are around in the money. And there are in the money contracts. You can literally buy, what I got, green right now? Yeah, I got green. You can literally buy contracts, a call for 230 that's already in the money. Yeah, it's going to be the same price. That's called in the money. And you could do the same for a put. You can buy a put that's 230 also. You see what I'm saying? And so with this being said, these contracts are way more like, they call it volatile, because when this price goes up, down, these get affected a lot because you are literally standing on top of the price. If you understand what I'm saying, instead of being under or over. Like if this was to go down a little bit, the 240 call gonna lose some money, but it's not gonna lose all that. It's not gonna lose a lot of money as long as it don't go all the way down to like 200. But if it start going 235, 236, you're gonna start gaining some money, but you're not gonna really start gaining until you hit this and start going above 240. Once you here and you start going below 230, you losing money on your contracts. Once you start going above 230 for the put, you losing money on your contracts. You got to go below the money for 230 to make money on your puts. You got to go above for the calls to make money. You see what I'm saying? So this should really help y'all out. If you got any questions, bro, ask away. But this is my video for y'all. Let me know if y'all fuck with it. Let me know if it was helpful. Let me know if y'all learned something. And yeah, that's it.